Is passive investing costing you more than you think? Active ETFs aim to beat the benchmark, while passive ETFs just settle for them. Embrace an active strategy that helps you build stronger portfolios. Invest with a global leader in active fixed income ETFs with JP Morgan Asset Management. Visit jpmorgan.com/getactive to learn more. JP Morgan Asset Management is the brand name for the asset management business of JP Morgan Chase & Co. and its affiliates worldwide. This communication is issued by JP Morgan Distribution Services Incorporated, member of FINRA.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that-with-Acrobat. The Chase Ink Business Premier Card is a pay-in-full card with flexibility made for business owners who make things happen. Earn a total of 2.5% cash back on every purchase of $5,000 or more. Plus, earn unlimited 2% cash back on every other purchase, giving you unlimited earn potential to invest cash back into your business. Ink Business Premier is part of a suite of credit cards from Chase for Business, designed to meet your needs every step along the way. Learn more at chase.com/business card. Chase for Business. Make more of what's yours. Account subject to credit approval. Restrictions and limitations apply. Cards are issued by JP Morgan Chase Bank, N.A., member FDIC.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
Bloomberg Audio Studios. Podcasts, radio, news.
This is a breaking news update from Bloomberg. Instant reaction and analysis from our 3,000 journalists and analysts around the world.
The most divided Fed since before the pandemic voted to lower the benchmark rate by 25 basis points as investors expected. But there were 3 dissents for the first time since 2019. And on the dot plot, a total of 6 members of the committee suggested they were not in favor of lowering rates. There's also a hawkish line in the statement. In considering the extent and timing of additional adjustments to the target range, bringing back language from a year ago when they paused their first round of rate cuts. No surprise, Stephen Myron wanted a half-point reduction, but in something of a surprise, Austin Goolsbee joined Jeffrey Schmidt in dissenting for no cut at all. Next year's dot plot suggests just 1 cut coming. 7 members want no move, however, including 3 who think the rate might go up. The committee statement says economic activity has been expanding at a moderate pace, and the latest forecasts show a consensus GDP figure of 1.7% for this year. But in a big move up, they have revised growth forecast for 2026 to 2.3%. Unemployment forecast to finish this year at 4.5% will fall back to 4.4% next year. Using identical language from October, the statement says job gains have slowed this year and the unemployment rate has edged up through September. Nodding to the government shutdown-caused absence of data, the statement repeats that more recent indicators are consistent with these developments. There's no change in the inflation assessment. It has moved up since earlier in the year and remains somewhat elevated. However, it is seen slowing markedly next year. PCE headline from 2.9% this year to 2.4% in 2026. And as always, they won't reach their 2% target for 2 more years in 2028. Core PCE will finish the year at 3%, falling to 2.5% next year. As for the balance sheet, the statement now says reserve balances have declined to ample levels. The Fed will buy shorter-term treasuries, mostly bills, but up to 3-year notes, as needed to maintain that ample supply. The first operation will be announced tomorrow, with the first purchases on Friday of approximately $40 billion in Treasury bills. Guys?
Michael McKee, stay close as we parse through this. Right now, what you see in markets is a collective cheer. Perhaps this was supposed to be a hawkish cut. The market is taking it slightly differently. S&P had been lower. Now it is positive by almost 0.2%. Euro climbing, dollar falling on the heels of what does seem to be like more Fed cuts. And across the board, 2s, 10s, and 30s, you are seeing a bid into bonds with this feeling that this is a Fed that not only is going to support rates with further rate cuts, but also with additional bond purchases. Tom.
To me, the most interesting nuance here is the dissent of the gentleman from Chicago. This is brilliant academics out of Milton, Yale, and the Massachusetts Institute of Technology. Austin Goolsbee is basically our technology president. He's wired into the internet, wired into the computers. And I'd love to know if his dissent has to do with the vibrancy of AI, which leads to a better productivity, a better GDP. Let's be careful what we do.
Yeah, right now we're looking at nine votes for and 3 dissents. Bob Michael of JP Morgan with us here. What's your first reaction of this decision?
Not as bad as it could have been. There could have been a lot more dissents in favor of no rate cuts. When we look at things like PCE, we expected they would lower core PCE by 1/10. They did that. They left the unemployment rate for next year roughly where it was last year. They did raise their expectation of GDP a couple tenths from where it was. So to me, that seems to be, if you want to call it a hawkish tilt, the one hawkish tilt. And of course, adding the extent and timing of additional adjustments to rate policy going forward, that was pretty much in the market. So I think mostly as the market expect and nowhere near as bad as the market feared.
So not maybe as hawkish of a cut as people thought it might have been. Joining us now is Jim Bianco of Bianco Research. Jim, what's your first reaction to this decision, which, as Bob was saying, isn't as bad as it could have been? It could have been 4 dissents or 5 dissents, only 3 dissents. Is this a victory for Jerome Powell?
It's a victory for Jerome, but I'll take the other side, Bob. I'll say that it's not as good as it could have been. I was hoping for a 7-5 vote. I was hoping for a Fed that was more divided, that was more independent, that was going to send in a message to the administration. You could put a guy in that wants to go to 1%, but he's not going to bully us to cut rates next year just because he's the Fed chairman. They kind of left the door open. I think that the Fed can be bullied by the next Fed chairman to do the bidding of President Trump.
Bob, you were saying that you wanted to respond?
Not as good as it could have been with more dissents. I think if you're the administration and you're invested in this market, this is pretty much as good as it could have been, other than no dissents. I'm not sure how additional dissents make this better.
Will McKee dissent at the press conference?
Well, let's find out. Mike, you were parsing through this. You've got something to add. What do you see?
Yeah, well, the point I'd like to make is that the SEP shows that growth is going to pick up significantly next year, unemployment is going to go down, and inflation is going to go down significantly next year. So what was the rush to cut rates today if they think that's the track that we're on? I think that's going to be a key question for Jay Powell in the news conference. Does this raise the possibility that they could be going the wrong direction with rates? There were some people who made that case before we went into today's meeting, and they're going to be still raising questions about it going forward.
Michael McKee, thank you so much. We will be catching up with you and, of course, listening to your questions. Jim, this is something that is near and dear to your heart, as you call yourself a self-dubbed inflationista. Do you think that this really adds to that inflationary pressure if the Fed essentially is accepting that they're not going to get down to their inflation target for 6, 7, potentially even 8 years?
I agree. I think that the Fed has to be very worried about that. We're worried about affordability right now. The price CPI is up 27% since the end of COVID, and that's what people are upset about. How do we fix that? We need the inflation rate to run below 2% for a while so that wages can catch up. If the inflation rate is going to stay at 3 and moderate to 2.5, that is going to keep the affordability anger white hot over the next year to year and a half or so. And so I don't think that accommodating that by cutting interest rates is going to help. And that's the question I hope the chairman gets is, how are you helping affordability with 175 basis points of cuts in the last 14 months?
Jim, we got to review the past here. You were a leader on saying that inflation would be sticky. It was a lonely call years and years ago, and Bianco of Chicago said, you know what, folks, we're not falling down to 2%. So here we are, Jim Bianco. I just want to know the efficacy, Jim Bianco, where he says in the press conference, basically, one and done. We made a rate cut. Maybe we will have a sequence of future rate cuts, but we really now have to wait and see what the data says. Isn't that where we are, Jim Bianco?
Well, that's if that's what he says. And again, what I was trying to say before is if the chairman imitates that it's one and done, means the chairman's running the show. And in May, we're going to have a hand-picked successor from Donald Trump running the show, and we know what Trump thinks about interest rates, and that person's going to want to have lower rates. But if he does say that, then maybe the market will take it a little bit differently, and we'll see if he does. But most of the time, he'll just say he's going to be data dependent, and it depends on what the data is.
This is an important vignette, folks, that I think just so valuable. I'm in a room with Axel Weber, Shirakawa of Japan, the wonderful John Lipsky with all of his work on New York Wall Street, many other worries. Tom Honig was there from Kansas City. And the room fell silent, Bob Michael, when they talked about the next regime of the Fed and the risk here that it would be cut. Is that a legitimate fear that the next chairman and the apparatus will allow us to go towards some regime of new low rates?
Well, I think you have to look at which Fed presidents are coming onto the FOMC next year, and they're mostly in the hawkish camp. So whoever you put in as the Fed chair has to be very persuasive. And I guarantee you the president isn't looking to appoint the next Paul Volcker. They're looking to appoint someone who believes in supply-side economics.
And Lisa, this is critical. This is absolutely critical that we have an analog here with the Bank of England that over time has told the governor of the Bank of England and their chairman equivalent, no, we're not in agreement. We're not going to do it. Is that what our 2027 looks like?
Part of the problem is people get overwhelmed by the state of events. And this is something that you talk about a lot. And Jim, I'd love your thoughts on that. This idea that this is a Fed that is now buying bonds once more, buying notes once more. And they're doing so because of reserves issues and really technical considerations for the market. They don't want another repo freakout. At this point, though, it does indicate a structural issue with how much debt is out there, the government deficit that's not going down, and a question of the Fed's role. Are they being forced to monetize the debt in a way that will keep them artificially easy if you were just going off the economic outlook?
I think they are at least being forced to acknowledge fiscal dominance, that the fiscal situation is important. Basically, the funding market, the repo market, which funds the $38 trillion Treasury market, is too small. It's too small because the Fed has been doing QT and reducing reserves. Those interest rates, repo rates, have been going up. Now, one answer could be to tell Congress, you can't spend as much money. You can't run as big a deficit because the funding markets can't handle that size of a market. But if the Fed wants to elect to, let's expand the funding markets to meet the size of the bond market, you're telling Congress, go ahead, spend more money, run bigger deficits. We've got your back. We'll continue to expand that funding market to meet those goals. And the biggest driver of inflation over the last couple of years, other than the supply shock that we had in 21, has been government spending. And they seem to be encouraging more government spending.
Bob, do you agree with that?
Absolutely, 100%. But it doesn't change the fact that that's what's occurring and the market's responding to that. I look at everything that just happened in the last few minutes, and, everyone got what they wanted. Those hawks on the Fed that didn't want to see a rate cut, they got that. When you look at the Fed futures market, we had 2 rate cuts priced for next year, mid-year and the end of the year. Now there's only 1 price for next year, and it's in the fourth quarter. So you got what you wanted. You got the market moving away from being in a rate-cutting regime going forward. But if you look at the doves on the Fed, if you think about the administration, they got what they wanted. They got another 25 basis point taken off of base rates, and the market's responding positively to that. It's rare that everyone gets what they wanted out of an FOMC meeting.
Jim, I'd love your comments on that, this idea that everyone wins. If you do have monetization of the debt, yes. You do have ongoing fiscal spending, yes. But that helps support the markets, and we're not seeing runaway inflation. So what's the problem?
We're going to get a new Fed chairman. That's the big issue. And the new Fed chairman is going to be perceived to be having a political agenda. And you were hoping that the current members of the FOMC were going to act as an independent brake on a political agenda that was coming in. And that's why I wanted to see more dissents to signal that they were ready, willing, and able to be that political brake. Now, maybe they will once we get that new Fed chairman, but then that looks political that they didn't take the chance to do it before the new guy came.
Jim Bianco, thank you so much, as always, for your insights. This really is going to be the debate. How does Fed Chair Jay Powell position himself and position the FOMC as being politically independent at a time that's highly politically charged? We hear every single day about the Fed Chair from this president.
The redo of independence is the core issue, particularly the heritage of the Fed back to 1951, and it's under threat, no question about that. It'll be interesting to see if the president gives way. As Bob Michael mentioned, the FT article today talking about, well, maybe it isn't 100% or 90% Dr. Hassett, and you get to a point where there's a renewed debate. We'll have to see on that. To me, it's a Chicago Fed meeting. We had Goolsbee dissenting, which is a shock in itself, and to have Jim Bianco with us is wonderful. Diane Swank owns the high ground of Middle America with KPMG. She's not out of 3 zip codes in Manhattan and joins us this afternoon. I look, Diane, at this moment, and when I see Goolsbee's dissent, it's essentially a Chicago dissent. It's a dissent of productivity. Do we have any idea with this new AI that we have a new productivity that will allow for a better real GDP, a more effective and efficient America?
We don't know that yet. What we do know is that productivity growth has moved up, and that's because firms are doing more with less. We don't know that it's all from AI. We haven't seen enough adoption of AI yet to get there. And also what we don't know is how AI will be used, whether or not we'll see a lot of new jobs from this new innovation. That's usually what we see from innovation. Certainly that's not what Silicon Valley is telling us at this point in time. And also it matters who the gains of the AI actually accrue to. If those productivity gains continue to accrue to the owners of capital instead of workers, workers are going to feel left behind. And they're already feeling left behind because of the fact that the level of prices, as Jim pointed out, is just too high. Even if inflation were to cool from here, the level of prices are still too high.
Lisa, I set up that question because I knew what Dr. Swank would say. Who's going to be the winner of productivity? Who are going to be the winners out there? And that's the ultimate political tension.
Which is the reason why the Fed's role in this is getting increasingly politicized. Dan, I'd love your take on how this Fed is taking into account productivity gains of AI and talking about Goldilocks, because essentially that is the scenario that they laid out in their statement of economic projections.
Well, the Goldilocks scenario really requires, with productivity growth, it to be broad-based. And actually, people always forget this part of it. If productivity growth, they raise their growth rates for next year. If productivity growth is driving gains in overall economic growth, it means we can actually have higher break-evens on the Fed funds rate because the economy can grow more rapidly without having to lower rates. And I think that's important as well. And so we've really not seen all this yet. And I think it's still ahead of us. I am worried about the fact that we're getting fiscal stimulus in the form of the largest tax refund surge on record in the first and second quarter. Will hit between March and May. And we know that those tax refunds are treated like windfall gains due to the expansions of tax cuts passed in July of last year. They're retroactive to beginning of 2025. And that's going to be a big bump in fiscal stimulus at a time when we're still feeling the inflation from both tariffs and changes in immigration policy. And I think that's really important. We're seeing service sector inflation pick up as well.
If that's the case, Diane, why are not forward break-even rates rising substantially? I was looking just now at the 5-year, 4-year forward break-even rates, and they actually went down after this Fed decision, not up, even though exactly what you're saying, if you do believe that there will be some additional fiscal stimulus that would be inflationary, you would think that this rate decision would only encourage those inflation fears.
I think we've seen some of it in financial markets already. The fact that it's not happening today doesn't mean it won't happen. And we've already seen some nervousness in the bond market, skittishness about the size of debt that they have to absorb, the mega merger deals that are coming out that are also financed by debt. All of that together, along with the fact that we're now going to see in 2026, the government debt is going to eclipse the size of the economy. It has not done that since World War II. And so we're moving into new territory. And I think a lot of things, people are sort of looking at the way the world was rather than what's changing, and things are changing very rapidly.
If you are just joining us, we did get that Fed rate decision. They did lower by 25 basis points as widely as expected. 9-3 vote, 3 dissents. The news really is that Austin Goolsbee joined the Fed's Schmidt in dissenting, saying that they should not lower rates. You, of course, had Stephen Myron, Fed governor, talking about a 50 basis point cut, dissenting on the other side. Not as many dissents as people had expected. The Fed did revert back to what we saw in the October statement, using language used just before pausing rate cuts. So potentially the last Fed rate cut for a long time by this chair, Jay Powell. I'm just wondering, Bob, if you think that right now this market is saying they are okay to do this, that the data that is available really doesn't signal that this cut and then maybe one more next year really is going to be inflationary.
Well, I think that's what the market's hoping for. I think there are a lot of businesses that we invest in where we do see the productivity gains from AI already. We also know within our own bank there are significant productivity gains. So some of that is already out there. The unfortunate price reset from pre-COVID levels to today is also a problem. I get that. But that's dampened aggregate final demand. What do we want going forward? Do we want the disinflation we seem to be in and what the Fed is projecting? Or do we want deflation where prices come down? I would argue we still want disinflation, and hopefully there will be a point in time in the not too distant future where wage growth and the trend in disinflation will normalize prices again. But all of that still is a headwind to consumption. So businesses are very careful how much cost increases they push through now.
Can I do a counterfactual?
Please.
Diane Swank, if we got a 50 beep Myron cut, what would happen to the American economy now? With the financialization of the American system, if you gave us a 50 beep cut now, it'd be a veritable banking explosion, wouldn't it?
It would certainly add a lot more stimulus to what we're already seeing, and stimulus is heat. Heat is inflation, unless you can really get all those offsets from AI in the right places. And I think that's the hard part, is the old economy is where the tariffs are hitting the hardest in manufacturing activity. And we are seeing it come through in prices. And we're also seeing labor shortages, even as the labor market weakens, in pockets where immigrants have dominated. That's showing up in prices as well. In-home elder care, childcare costs, all soaring. That was just in September, and those shortages have only gotten worse since then.
Lisa, 2/20/20. I looked at the clock right when Diane Swank said tariffs. First time we got the tariffs was 20 minutes into the show. For most of our audience, tariffs are a big deal. They're affecting their groceries, their health care, everything in the service sector as well.
Yeah, plastic Christmas trees, 15 to 20% higher because of tariffs. There you go. So this also is
a real Christmas tree or fake?
Fake Christmas tree, but it's also increasing the real ones because there are other people. Diane Swank, we'll let you stay out of this conversation. Thank you so much for being with us. Joining us now for this conversation, not this conversation, Matt Lazzetti of Deutsche Bank with us, as you typically do before the Fed press conference. Matt, just first, what's your impression? 9-3, was this what you thought would happen?
Yeah, to be honest, I think in terms of the statement, the SEP, the dissents, I think it was very much in line with expectations. You know, certainly there was scope to get greater dissents from a hawkish direction than what we got. I think 4 regional Fed presidents, potentially Governor Barr, was also leaning against this cut. But we always thought that it was the job of Chair Powell, through the statement, the language change that we got there, but then I think coming up through the press conference signals that he sends to try to rein in some of those dissents, to have a hawkish message that allows those officials to speak through that. And so I think we probably got that as well. You're seeing markets respond by taking rates down. I don't think that's really anything that we saw in the statement or the SEP or the dissents. I think it really was the Fed ramping up reserve management purchases, these T-bill purchases, a little bit earlier than was expected.
Matt Lazzetti, Binky Chadha is high on the street looking at the equity markets. He says the stock market's going to go up, up, up. How do you attach Lazzetti economics to Bikram Chadha's huge equity outlook?
Yeah, I think the good thing about how we do it here, it's internally consistent. So I think Binky takes our economic growth forecasts, our global economic growth forecast, and builds that into his earning projections. We have 2.4% growth for the U.S. economy over the next year. That was sounding, I think, quite bullish relative to consensus expectations. But I would note the Fed median forecast came up to 2.3% today. I think was revised higher than what many anticipated and is now much closer to our own expectations. So I think these two things are mutually reinforcing. We see a stronger growth backdrop. We see financial conditions easing through Binky's equity channel, and those two things reinforcing each other over the next year.
Matt, your other colleague, Jim Reed, put out a provocative question earlier this morning saying, what if the next Fed move was up? At what point do you think that the move that the Fed is laying out really sets up that counterfactual in a more real way?
Yeah, certainly a provocative question. And I think over the next year, we are getting more questions about that. And I think it's more coming from the global sphere at this point. You're seeing places like the RBA turn a little bit more hawkish. There's questions about the ECB. Bank of Canada are seeing stronger economic data as of late. For the Fed specifically, though, I think you need two things to happen. One, you have to have a clear elimination of downside risk to the labor market. We are not there yet. There's still some fragility in this labor market over the next several months. Perhaps by the end of next year, we could get there. And two, you need the labor market to return as a source of inflationary pressure. So you need the unemployment rate to decline, quits rate to move higher, and wage growth to accelerate. I think it's possible. I think you are seeing a substantial reduction in labor supply in the U.S. economy. I think if you were to add on even more fiscal stimulus, so if we were to get these $2,000 stimulus checks from the Trump administration, I think that's the type of dynamic where that could really shift the debate. People would begin to think a little bit more actively about rate cuts in the U.S. But to be clear, I don't think we are there. Our baseline expectation is the next move is a cut.
Bob, what do you think? What do you think it would take for the Fed's next move or a move next year to be a rate hike and not a cut?
Well, I think you'd have to see the fiscal stimulus from the One Big Beautiful Bill Act hit and accelerate business investment and consumer spending. You'd have to see a labor shortage resulting from that, and you'd have to see a wage price spiral. Maybe you'll see that in the second quarter, but right now the Fed threaded the needle. Can't we just enjoy this into the holiday season?
Come on, you know us.
That's the smartest thing I've heard today. That's the smartest thing I've heard. And Powell's a piñata, I get that. But the bottom line is we have a prosperous economy for the haves. Let's not upset that apple cart while everyone well-meaning tries to help people that are struggling so much. I mean, that's threading the needle right now is what we're doing.
Well, yes, but let's not forget that the One Big Beautiful Bill Act also has no taxes on tips, overtime, Social Security payments.
Right.
A lot of those are concentrated in the bottom couple quintiles of earners. So there should be some relief coming there.
Where's your lack of conviction? Matt Lazzetti on an outlook and off of this Fed meeting today. Where's the question of your conviction into next year? What are you most worried about?
Yeah, I think in the very near term, it's that the labor market dynamic, which is this fragile equilibrium with low hiring and low firing, breaks to the downside. That you begin to see layoffs pick up. I really don't think we see that evidence as of yet, but it's a real risk over the next several months.
Do you agree?
I think over the course of 2026, I think there's some risks to the upside here. As Bob mentioned, on the fiscal side, the stimulus checks that have been floated, not part of our baseline, but would be a very real upside risk. And then I think we just can't put aside these risks around Fed independence. And, we heard Treasury Secretary Bessent talking about regional Fed presidents, and we have to go through those votes. And you have a Supreme Court case for Lisa Cook coming up early next year. So there, I think that there are a lot of risks associated with it. From a Fed independence perspective, inflation risk potentially to come, long end of the bond market also at risk potentially from that.
Matt, we have about 3.5 minutes before the press conference begins. From your perspective, what's the one question you have for Fed Chair Jay Powell, potentially at the last Fed cut that he oversees?
Yeah, I think it's a little bit around the language that they introduced into the labor market and into the statement. How are we to think about that? Is that clearly sending a signal that there's a much higher bar in the near term? I also would ask him, are you internalizing what could be a very weak jobs report next week in today's decision? I think that's a really important thing for the market. I think the Fed would probably want to take out some of the sensitivity to next week's data. I think one of the reasons that Chair Powell wanted to push this rate cut through was an expectation you could see some weakness there. My expectation is, next week's data is going to be volatile. They are really putting more weight on the December jobs report in early January and the data we're going to get early next year in that assessment. But I'd like to get confirmation of that from the chair today.
Matt Lazzetti, thank you as always for your time, and I look forward to hearing what you think after the Fed conference. This is an important point. How much is this, in some ways, forecasting that December 16th jobs report that we should have already had? It should have been sort of 1-2 punch where last Friday we got the November jobs report. They took that data into hand, and then this meeting, they responded to it. Bob?
Yeah, I think you can go back to September and say this is another risk management adjustment to policy, that there are some signs of a soft labor market. You're far away from what you're forecasting as your neutral rate. Why not take another 25 basis points off of that? It will help corporate America. I'll get a lot of questions in the next few days. Does 25 basis points actually do anything? Let's remember, most of corporate America are small and middle market businesses. Think of a $50 million EBITDA company. They generally have 7 times leverage. They've got $350 million worth of debt on top of $50 million in EBITDA. It helps them a lot. It helps stabilize middle market corporate America significantly.
If we say it's an original meeting, we've got to stagger to the next meeting, and we'll be wiser. We'll have data and all that. But as Lisa mentioned at the top of the show, the political overlay here is extraordinary. What did J.P. Morgan's Washington experts say about the politics of January?
Well, the question I would want to ask Powell is, were there only 3 dissents, or was there a considerable amount of bargaining to go from 5 dissents to 3 dissents? And was that in the statement? And then you ratcheted it up, GDP, 0.5% from where you were at the last summary of economic projections. His answers to questions like that will tell you how politically influenced the current Federal Reserve Board is.
That was a fantastic question, and I hope that he gets asked that as we really look to understand just what kind of clutch the Fed chair holds over this committee. Bob Michael, as always, thank you so much for being with us for all this time. Truly, always one of the absolute best. Right now in markets, a collective sigh of relief. It could have been a lot worse. That is sort of the message coming from it. The S&P up 0.1%. NASDAQ still suffering a little bit, down 0.2% suffering, I say, still near all-time highs. And the Russell 2000 seeing that pop up 0.6%. What you are seeing in the bond space, 2s, 10s, and 30s, is this lift to bond price down in yield as people expect to see some sort of bond purchases as well as a rate cut coming in next year. It really seems to me that Jay Powell really has the chance to split the difference.
We'll have to see. I'm going to watch the bond vigilantes. I think they're in the press conference as well.
Hey, Ryan Reynolds here for Mint Mobile. One of the perks about having 4 kids that you know about is actually getting a direct line to the big man up north. Mm-hmm. And this year, he wants you to know the best gift that you can give someone is the gift of Mint Mobile's unlimited wireless for $15 a month. Now, you don't even need to wrap it. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.
This podcast is brought to you by FedEx, the new power move. Hey, you know those people in your office who are always pulling old school corporate power moves? Like the guy who weaponizes eye contact. He's confident. He's engaged. He's often creepy. It's an old school power move. But this alpha dog laser gaze won't keep your supply chain moving across borders. The real power move? having a smart platform that keeps up with the changing trade landscape. That's why smart businesses partner with FedEx and use the power of digital intelligence to navigate around supply chain issues before they happen. Set your sights on something that will actually improve your business. FedEx, the new power move.
Hey, it's Rich Davis from Covino and Rich. The Toyota Tundra and Tacoma are designed to outlast and outlive, backed by Toyota's legendary reputation for reliability. So get in a Tundra with the available iForce Max hybrid engine, delivering exceptional torque and towing capacity. Or check out a Tacoma with available off-road features like crawl control. It could take you back to the trails. Toyota trucks are built to last, year after year, mile after mile. So don't wait. Get yours today. Visit buyatoyota.com for deals and more. Toyota, let's go places.
Residents at Brightview Senior Living Communities enjoy enhanced possibilities, independence, and choice. Brightview Dulles Corner and Great Falls offer vibrant senior independent living, assisted living, and memory care services through various daily programs, chef-prepared meals, safety and security, transportation, resort-style amenities, and high-quality care. Take financial possession of your apartment by December 31st, 2025 and save. Discover more at brightviewseniorliving.com. Equal housing opportunity.